For most of modern history, banks did one simple thing. They took deposits, they made loans, they held risk. It was a straightforward model, transparent, understandable, imperfect, but visible. Then something changed. Finance stopped being about lending money. It became about designing it. Welcome to the age of financial engineering, where risk is sliced, repackaged, sold, insured, leveraged, and transformed into products so complex that even their creators sometimes struggle to explain them. This is the story of how finance moved from Main Street to mathematics, and how innovation quietly became both the engine of growth and the seed of instability. In the late 20th century, a new philosophy took over Wall Street. Why hold risk when you can distribute it? Instead of keeping loans on their books, banks began bundling them together and selling them as securities. Mortgages were pooled, credit card debt was pooled, auto loans were pooled. Then those pools were sliced into tranches, layers of risk. The safest slice received priority payments and top credit ratings. The riskiest slice absorbed losses but paid higher returns. This process was called securitization. On paper, it made sense. Risk was diversified. Capital was freed up. Banks could lend more. Investors could choose their level of exposure. Everyone won. Or so it seemed, because something subtle had changed. The bank that issued the loan was no longer the one holding the risk. And when you don't hold the risk, your incentives change. If securitization was the foundation of financial engineering, derivatives were the acceleration. A derivative is simple in theory. It's a contract whose value depends on something else: an interest rate, a stock price, a mortgage pool, even the weather. At first, derivatives were tools for hedging. Airlines used them to stabilize fuel costs. Farmers used them to lock in crop prices. But in the hands of Wall Street, derivatives evolved. They became instruments not just for protection, but for leverage. Credit default swaps allowed investors to insure against bond defaults. But you didn't have to own the bond to buy the insurance. You could bet on failure. That meant the same mortgage bond could have multiple insurance contracts layered on top of it. Risk wasn't reduced, it was multiplied, invisible, off-balance sheet, interconnected. By the early 2000s, the global derivatives market wasn't measured in billions. It was measured in trillions, then hundreds of trillions, then over $1 quadrillion in notional value. A number so large, it stopped meaning anything to the human mind. Financial engineering introduced something new into the system: opacity. Products became so layered that understanding them required advanced quantitative models. Risk models replaced judgment. Correlation assumptions replaced experience. Probability distributions replaced caution. And as long as markets were calm, the models worked. Volatility was low. Defaults were rare. Liquidity was abundant. But models are built on the past. They assume tomorrow behaves like yesterday. And financial engineering quietly built a system that only functioned in stable conditions. It was a system optimized for efficiency, not resilience. Here's the paradox. Financial engineering was designed to spread risk. But spreading risk doesn't eliminate it. It connects it. If one institution fails, in a simple banking world, losses are contained. In a financial engineering world, everything is tied together. Banks hedge with other banks. Funds insure against other funds. Institutions depend on counterparties to honor contracts. The system becomes a web, strong when tension is evenly distributed, fragile when one strand snaps. The 2008 financial crisis exposed this reality. Complex mortgage securities had been rated safe. Credit default swaps were sold as insurance. But when housing prices fell and defaults surged, the models failed. Liquidity disappeared, and the interconnected web began to unravel. AIG, one of the largest insurance companies in the world, had sold massive amounts of credit protection. When counterparties demanded collateral, it couldn't meet the calls. It wasn't just about mortgages anymore, it was about systemic exposure. Financial engineering had transformed localized risk into global contagion. After 2008, regulators stepped in. Banks were required to hold more capital. Derivatives were pushed towards central clearinghouses. Stress tests were introduced. But financial engineering didn't disappear. It adapted. New structures emerged. Private credit expanded. Shadow banking grew. Exchange-traded funds made complex strategies accessible to retail investors. Algorithmic trading increased speed and interconnectedness. Structured products evolved. The tools became more sophisticated. The system became faster, and risk continued to evolve. Today, financial engineering extends far beyond Wall Street. Volatility products allow investors to trade market fear directly. Leveraged ETFs amplify daily returns. Crypto derivatives create synthetic exposure to digital assets. Risk can now be engineered on demand. Want triple exposure to a stock? It exists. Want to short volatility? There's a product. Want exposure to corporate debt without owning bonds? Structured solutions are available. Innovation has democratized access, but it has also democratized complexity. The average investor is now exposed to structures that once existed only inside investment banks. And most participants don't fully understand the mechanics beneath the surface. Financial engineering thrives on optimization, capital efficiency, return enhancement, risk-weighted precision. But optimization reduces buffers. It removes friction. It assumes continuous liquidity. In a world of engineered finance, everything works beautifully until something unexpected happens. A sudden rate shock, a liquidity freeze, a correlation breakdown. Then the structures that once amplified returns begin to amplify losses. And because everything is interconnected, stress spreads quickly. The speed of modern markets means reactions happen in milliseconds. Algorithms don't panic, but they do withdraw. And when liquidity providers step back simultaneously, markets gap violently. This is the vulnerability of engineered systems. They are brilliant under normal conditions. They are unstable under extreme ones. At its core, financial engineering is not inherently evil. It has funded businesses, lowered borrowing costs, enabled global capital flows, supported innovation. The question is not whether engineering is good or bad. The question is whether incentives align with stability. When profits are privatized and losses are socialized, risk-taking expands. When complexity hides exposure, accountability fades. When markets reward short-term gains, long-term fragility builds. Financial engineering magnifies whatever incentives dominate the system. Artificial intelligence is now entering financial modeling. Machine learning optimizes portfolios. Automated systems price derivatives. High-frequency trading adapts in real time. The next generation of financial engineering won't just slice risk, it will predict it, or at least attempt to. But prediction has limits. Black swans don't announce themselves, and no model fully captures human behavior under stress. The real danger isn't innovation, it's overconfidence in innovation, believing that complexity equals control, believing that risk has been conquered. History suggests otherwise. Financial engineering is a tool. Like leverage, it amplifies outcomes. Used wisely, it strengthens markets. Used recklessly, it destabilizes them. The age of financial engineering has made markets deeper, faster, and more sophisticated than ever before. But it has also made them more interconnected, more opaque, and potentially more fragile. Risk hasn't disappeared. It has been transformed, repackaged, redistributed, hidden inside structures few fully understand. And as history repeatedly shows, the more engineered a system becomes, the more surprising its failures can be. This is the age of financial engineering, where innovation drives growth, complexity drives profit, and the next crisis may already be embedded inside the very structures designed to prevent it. Welcome to Cash and Chronicles, where money, power, and history collide.